Good morning, gents. How are we? Everybody okay today?
Good.
Good. I think we're all just suddenly realizing that we have a bank holiday weekend coming up on Monday. I made the rookie mistake of looking at my diary and offering some availability for Monday because I thought, cool, my diary's pretty clear on Monday. That's unusual. Turns out it's because it's bank holiday. Always the way, isn't it? Always the way. So thank you again for joining us today. Welcome in, everybody. As always, Club Lives, our webinars tend to run for the full hour, which is great news. 1st of May is upon us. Where is this year going? It is absolutely flying around. The sun is shining today and everybody's got a bit more of a spring in their step and a smile on their face because the weather is looking better. As always, please drop a quick hi, hello, or a good morning in the comments section so we know everything is working how it should be, which is good. Jade, good morning to you. Good morning, everybody else that's joined us again for today's session. As always, if you've got any questions at any time, please do let us know. These guys are going to be going through quite a bit of detail today, so make it as interactive as possible. We always like to challenge everybody. Good morning, James. Good morning, Nick. Hopefully you can all see and hear us well. So today, as always, there are two ways to engage with today's session. There's the chat function, which you're all typing in now, or there's a Q&A section, which keeps things a little bit more anonymous. So feel free to use whatever channel that you prefer. When you exit today's session, there will be a feedback form that pops up. On that feedback form, please let us know how the guys presented today, the relevance of the content. There'll also be a part on that feedback form where you can request your CPD certificate as well. So when you hit the exit now or leave button on the webinar at 11 o'clock, a feedback form will pop up, and that's where you can give us some wonderful feedback, the good, the bad, the ugly. We need to hear it all. It's the only way we get to improve when it comes to delivering content, but it's also a way for you to request your CPD certificates, which I know is important to everybody. So without further ado, let's kick things off. As always, I'm just going to walk through a bit about the club, who we are. Amanda's background is running two financial planning firms under an AR arm, so a self-employed model and a employed advisor model. So she was a managing director for two quite large firms in the industry. Myself and Lewis have run a fixed fee subscription recruitment business for over 10 years, focusing solely on financial planning firms. So any role within the four walls of your business, we fix the cost and we really help you scale your business. Jade is the backbone to everything we do. We couldn't do what we do without Jade. She is our glue. Nothing gets past that lady. I swear to God, we wouldn't be the firm we are if it wasn't for Jade Ling. So thank you very much. And she's in the chat today. I've shared my QR code for my LinkedIn. Do connect with me when you get a minute, because off the back of today's content and off the back of all the other content we create and our club webinars, we will create articles, short snippets. We'll create a community for you to continue on asking questions, and really it's just a way to stay up to date with everything that's going on in the club as well. So please do connect with us. But obviously, look, we couldn't do what we do without the incredible support of all of our collaborators. Every single one of these firms not only help the wider community, but they do support our club members as well. Everybody's going through different challenges, different growth periods. Some of these firms can have a massive part on the outcome of your business. So a big shout out to everybody now collaborating with the club, and obviously content delivered by our awesome collaboration partners. Today we are with ISIO and the team, and no doubt we're going to have some really good content from these guys as well. Next slide when the mouse wants to work. As you all know, we create a community for everybody. So outside of the club membership, we've got WhatsApp groups depending on the role that you play within your business, whether you're an owner, power planner, ops manager, just a financial advisor, whatever it may be. We've got some really cool WhatsApp communities. If you want some instant answers, that's your place to go. I'd always recommend you mute the group because around tax year end and budgets and everything else, it does go a little bit crazy. So do mute the group and pop in and add some input and seek help when you need to. Club Lives are our weekly webinars. I say weekly at the moment. These guys have got me running 2 a week. So I'm always on a webinar these days. And the podcast you can listen to on all your normal platforms, hear from business owners that are growing financial planning businesses in today's market. So a couple of ways that you can connect with the club. 3 webinars lined up. As I said, I'm doing these all the time on the 8th of May. So that's next week. We've got IntelliFlow. We're focusing on how firms actually scale without things breaking operationally, which is always a talking point amongst many firms. Then on the 22nd of May, FE Fund Info, I believe I'm with Matt again, and me and Matt, we can talk for ages all things tech, but it's about building a properly integrated advice setup and fixing those disconnected systems. I think that is a pain point of many firms using multiple systems that don't integrate or talk to each other. So we're going to have a good session around that. And on the 29th of May, we are with Bear Rock again, looking at how your evidence, how you evidence client outcomes under consumer duty in a way that actually stands up. So across the 3 webinars, it's scaling, integration, and client outcomes, all very practical sessions. Again, all coming with an hour of CPD per session. Today, I'm joined by Ajith, CIO at ISIO Investment Management and chairs their investment committee, over 20 years experience across global markets. Ajith, you lead the investment strategy, identifying trends and opportunities and working closely with clients on portfolio solutions. Hope I hit the nail on the head with the introduction. You'll also see Tom and Ben is with us today, and no doubt they'll step in and say hello and explain the role that they play within ISIO shortly. Every time I hit next slide, it doesn't seem to want to play ball. As we know, we ask a couple of questions when people sign up today. It's this time where we relay that back to you. So we've got a good mix of IFAs, planners, and business owners in the room. So we've got a pretty experienced, switched-on room. So I'm expecting some really good questions from the audience today. So most firms already have something in place, typically MPS or multi-asset, but a lot are still evolving or refining what they're doing. Where the interest really came through was around bonds and portfolio construction, understanding how it all fits together in practice. How are you guys finding the market at the moment when we talk around bonds and portfolio construction and really understanding how that all works in practice? Is that something that you typically hear all too often, would you say? Guys, can you hear me? Has everybody froze or is it just me? No, you can hear me. Right. Okay, fine. So Jeff, over to you, mate. Over to you. I'm going to stop sharing my screen now. And then we can continue with today's session. So guys, thank you very much for joining us.
Thank you, Lee. Thank you for that introduction. Morning, everyone. Great to be here. So as Lee mentioned, I'm joined by 2 of my colleagues, Tom Wilson, who's a portfolio manager and head of credits, and Ben Matthews, portfolio manager and head of equities. So the topic for today is MPS portfolios and learnings from institutional investors. So I'm guessing that the first question that comes to your mind is, what do we mean by that? What's our key message? It's very simple. If you look at some of the biggest investors in the market, so pension funds, insurance companies, endowments, sovereign wealth funds, their way of managing money, the institutional approach, is very different to how the MPS retail portfolios are being managed. And we have a very strong belief that by importing that discipline, that institutional discipline, so high quality approach to portfolio construction, asset allocation, implementation, by importing that discipline, you can add a significant amount of value to MPS and retail portfolios. So So we'll be spending the next 45 minutes discussing this topic. And to do that, we have broken this down into three separate sections. So the first section, we will be talking about the high-level differences between the two approaches. And we'll talk about what the key benefits are of the institutional approach. The next section, we will talk about the various asset classes, equities, bonds, diversifiers, what type of instruments can be used under the institutional approach, and what are the roles of these various asset classes under the institutional approach. And the third and final section, we'll bring it all together. What does it look like in terms of actual portfolios? And we'll be comparing two portfolios under each of those approaches and finding out the major differences. So that's the plan. And hopefully by the end of this, you will have a clear idea of the major differences and the benefits. And at the very minimum, you will have a tool, you'll have a framework with which you can analyze new providers and new solutions in the market. So let's do that. But before we do that, I want to do a quick introduction to our firm. I am guessing many of you are not familiar with ISIO. So ISIO Investment Management is new to MPS and retail space. So we launched our MPS portfolios a year ago. It's been running for a year, but we're not new to the industry. We've been around for more than 21 years, and the first 15 years were spent with KPMG. So for the first 15 years of our existence, we were KPMG Investment Advisory. We came out of KPMG in 2020, and since then we also bought Deloitte's investment advisory business. So our heritage, our legacy is all institutional. So what do we do today? We have more than 350 billion assets under advisory, and most of that is UK institutional money. So defined benefit pension schemes, defined contribution pension schemes, and we advise some of the top names in UK, household names in UK. And to do that, we have a team of around 150 people who are dedicated investment professionals. And of that 150, around 40 people do portfolio management and research. And the final point I want to make here is the hot topic for a lot of retail investors, private markets. We have a lot of experience and credentials in that market. We have been involved in the creation and seeding of a lot of innovative private market solutions, especially in DC space, a defined contribution pension scheme space. So that's us. Hopefully that gives you a clear idea of who we are and probably more importantly, why we believe we are well placed to talk about the institutional approach. And one final disclaimer before I start with the body of the presentation. I know this is an educational session and not a sales presentation, but to talk about the institutional approach, we'll have to rely on our views, our beliefs, our processes. So my request to you is over the next 45 minutes or so, please consider our approach as a proxy for the institutional approach. We are just using our approach to bring these concepts to life. So that's an introduction and a brief disclaimer. Let's now jump straight to the presentation. So the first section, I told you the first section is to compare the two processes or approaches and see what are the major differences and what are the benefits of the institutional approach. So that's what we have done on this page. We start with the investment philosophy of an institutional approach, and then we move to the implementation aspects. How do you implement these ideas under the institutional umbrella? So under the philosophy, the first key point is that we strongly believe that strategic asset allocation drives long-term returns. So there is a lot of academic studies and data to support this. Almost 80 to 90% of long-term returns are driven by strategic long-term asset allocation. Tactical asset allocation, on the other hand, is very difficult to get it right consistently. And so what does that mean for you as an investor when you come through this institutional approach? The portfolios will have very limited turnover. So we'll still look at benchmarks, we'll still look at where the current allocation is versus benchmark, but doesn't mean automatic rebalancing or a lot of tweaking on the for tactical asset allocation. So that's the first point. Long-term strategic asset allocation drives returns. The second key point under philosophy is diversification is more than meets the eye. So if you look at most of the portfolios in retail space today, it's pretty much equities and bonds. And that gives you a certain level of diversification, but that's not enough. So what we do is we go a couple of steps further. We call it smart diversification. So we also do equities and bonds. We also look at that diversification. That's a starting point, but we add multiple layers on top of that. I can give you a couple of examples. The first one is geography. All of our allocations across equities, across bonds, they are geographically very well diversified. We don't have massive UK biases like you would see in most of the MPS portfolios. We believe that US has, if you look at a typical bond exposure, 70% is in US. The rest of the markets is 30%. So if you skip out US, then you are skipping out on a big portion of the bond market. So geographically, it'll be diversified. The second type of diversification could be market capitalization. So we are not just dependent on large cap names. Our portfolios will have mid cap, our portfolios will have small cap. So it'll be more diversified across market capitalization. And the final layer that I want to bring out, there are multiple layers, but the final layer in smart diversification is underlying risk. So if you think about a typical portfolio with equities and bonds, the underlying risk is corporate risk. If companies do well, if economies do well, then you will have better outcomes with equities and bonds. Can you bring a different type of risk? Can you bring consumer risk into that mix? So we will have allocations, and Tom will take us through this in a lot more detail. We will have investments that are linked to consumer risk in our portfolio to give you better diversification. So diversification is not just about equity and bonds. It's a lot more than that. So that's the second point. The third one is that equity is not the only return driver. So if you look at a typical MPS book, equity is the predominant driver of returns. Bonds are almost used as an afterthought. They're used for risk management more than anything else. We are very happy to go beyond that role for bonds. We use different parts of the credit market, niche areas within the credit market to add to the returns. So equities, they don't have to pull the weight on their own. Bonds can do a similar job and give you a well-diversified or better portfolio. So those are the three key points under philosophy. Now, let's look at how that's implemented. You take this philosophy and how do you put that to work? And that's on the other side, implementation. The first key point is that we only use active funds where it is justified. So the typical market, if you look at the market, you have a lot of people who do just passive, a lot of people who do just active, and a lot of people who predominantly do active. We look at data. We find areas where active management can add value. Only in those areas we do active management. And Ben will take us through the details and the data behind this in a second. But you will see that in institutional approach, we do, let's say, developed markets, active management doesn't add a lot of value. So we'll go passive there. But for EM and small cap, we do active. Credit, the risks are, it is asymmetric risk, so you do active management. So it's a combination of active and passive, what we call as value for money approach, selective implementation of active and passive. So that's the first one. The second one is it makes a lot of intuitive sense, but I want to make it very clear, which is if you are an institutional investor like us, we have 350 billion in assets. That gives us, whether it's through the retail portfolios or through the institutional, that gives us access to some of the top names in the industry, top strategies in the industry. But we use the entire weight of our assets to negotiate much lower fees. So if you look at our MPS book, and let's say you're allocating 25 million to a strategy, when we have negotiations with the manager, we are talking about not just the 25 million, we are also talking about the 500 million or 300 million that's sitting on the institutional side. And that allows us to get the lowest fee. So almost all of our allocations are in institutional share class, fee share class, not retail fee share class. That makes a big difference in terms of fees. And the last point on implementation, which is And this is probably the biggest difference. Everything else you probably would have guessed, but this one is very different, at least in my mind. Innovation. So when we go and look for a product, if we don't like that product, let's say we are looking for a particular fund in a particular asset class, and we looked for all the managers, all the products, and we didn't like it. Typically, retail investors, you'll have to just go with what you think as the best product available. We go one step further. We design, develop products working with managers. So we create solutions, we create funds. So the benefit to you as the end client is twofold. One, you get a very good product bespoke to your situation. Two, because we are involved in the creation of that fund, our clients get the best fees. So that's how we see implementation. So investment philosophy and implementation hand in hand. But hopefully that makes sense that the retail investors now deserve a much better institutional approach compared to what they're getting today. Let me pause there. If there are any questions, then
Yeah, Jeff, we've had a question come in, and it's really around the diversification and the innovation, and it can be seen to be a fairly new concept for for the retail space, right? Do you have an example of how you bring this to life?
Yeah, great question. So we've done this creation of products innovation across various asset classes with some of the top managers in the industry over the years. But let me give you the latest example. So last year, we were looking for an asset-backed securities, and Tom will go into the details of what it is and why we like it and all that. But think of it as a sub-asset class within credit. We were looking for an asset-backed securities product. And what we saw was that predominantly all the products in the market were European focused. And what that means is you're missing out on 70% of the ABS market, which is US. So we didn't like that fact that all the products were European focused. So we designed something that had both US and Europe. We took that idea to some of the top managers. We executed it with one of the biggest bond managers in the market. And we seeded it with 400 million from our institutional clients. And what that gave us was a good product, but on the fee front, our clients paid zero fees for the first year and 15 basis points from there on, which is a 10 to 15 basis points difference compared to what everyone else was getting. And to be very clear, all the benefits go to the end client. We don't gain from any of this. Our only gain is that our clients get the best solution. The other example of innovation, which is slightly related, is we have a unique position. We can see the best ideas in DB space. We can see the best ideas in defined contribution pension space. So one such idea in DC was that one of our clients were invested in a passive index fund, which was zero fees, but was guaranteeing a return of index plus 20, which is unheard of in retail space. So we took that idea from DC and planted it into retail. And that's how our cornerstone allocation for most of our MPS portfolios in terms of passive equity. So it's a lot of examples, but I thought those two would be most relevant for this forum.
Hopefully that answered the question. Thank you very much.
Thank you. So this was the first section, like what are the big differences? Now let's move to the second section where Tom will take us through bonds and Ben will take us through the equities. Yeah.
Thanks, Ajith. Morning, everyone. Great to speak with everyone this morning. Yeah, like Ajith said, my job today is to try and convince you all or explain to you why bonds aren't boring or why they don't have to be anyway, contrary to popular opinion, which has been in place for a long time. But on a more serious note, Ajith has already touched on how we think about things from an overall perspective, and I'll bring that to life with a few examples specific to bonds. So firstly, on the left-hand side, let's establish what's currently there, how are retail investors currently using bonds typically. And it's like I just touched on, it's very much as a secondary allocation to bonds, to equities, sorry. Equities tend to be the main event in the retail space, and bonds can feel like a bit of an afterthought. So they're often used purely to dampen volatility as a bit of a shock absorber in a portfolio, if you like. And they certainly can play that role, but we think they can do a lot more as well. Within a retail approach, this approach to bond investing tends to mean that they focus on very traditional areas, such as government bonds and corporate bonds, given that they're high quality, so unlikely to default, relatively easy to access and understand, and can be done passively, so relatively cheaply as well. But despite those benefits, we think sticking purely to these two areas and having a traditional approach is inefficient versus what we see on the institutional side. We think there's a better way of doing it, and that's for three main reasons. Firstly, these areas, yes, they're high quality, but they tend to be generate limited incomes. They generate a limited return relative to what's available in cash or the risk-free rate. So they tend to consistently drag on returns. And what that can create is a temptation to keep trimming them and adding more to equities to gain a higher return. But for obvious reasons, in terms of risk management and diversification, that's not always the best choice. So as I also mentioned, secondly, these areas tend to be relatively high quality, but that doesn't necessarily mean that they're always low volatility. So these areas tend to be quite sensitive to changes in interest rates. And as we've seen over the last few years, interest rates move around, and therefore so can the value of these bonds. So they might not always be as stable as retail investors first think. Lastly, we think an active approach, as Ajit has touched on, is better spent in bonds versus equities. So accessing government bonds and corporate bonds passively, we think is missing out on a lot of that upside potential. Ben's going to touch on why we think a passive approach, particularly in large cap developed market equities, is the best way. But by doing that, that frees up a lot of fee budget and a lot of governance budget to use bonds actively instead. So on the right-hand side, how does an institutional approach go about correcting some of these drawbacks that I've mentioned? Well, fundamentally, what they do is they put bonds at the very core of a portfolio, so on a par with equities and not just as a sidekick that can reduce volatility a little bit around the edges. So what we want in an institutional approach is to see bonds contributing to the upside and given a diversified source of returns rather than just being a shock absorber when things go badly and we see a bit of market volatility. And how do we do this? Well, it's by considering a much broader universe, including some niche areas, some newer areas, some areas that are better accessed via active management. So being a bit more creative and expanding beyond just the traditional areas of government and corporate bonds. But what are these areas, I hear you ask? So moving on to the next slide, we'll get a feel of what that broader universe contains. So excuse the corny reference to James Bond in the title, afraid we couldn't resist, but this slide hopefully brings that point to life that I mentioned. So the retail universe, as we see it, tends to focus on that bottom left quadrant. So high quality bonds, but relatively low income generating as well. We like to expand that a lot more and look at higher income generating bonds, but these aren't necessarily a higher risk. So we think overall, there's better risk adjusted return potential by at least considering and adding some of these alternative areas. One of the great things about bonds and the bond universe is that they come in all kinds of different shapes and sizes. So we see different types of borrowers, so governments versus corporates versus consumer, for instance, different credit ratings as well, some higher quality, some lower quality, different sectors within the market. We see some longer maturity bonds, some shorter that are perhaps a bit lower volatility, some that pay a fixed rate of interest, some that move with base rates. Considering all of these factors and using them as levers to dial up and down can really enhance a portfolio and make it bespoke to a retail investor based on their requirements. So we'll dig into this in a bit more detail. The main area that I want to do a little bit of a deep dive on is that top left area, asset-backed securities, or ABS as I'll refer to them as. But before I jump on to the next slide,
yeah, Tom, before you move on, yeah, if someone's asked, if by sticking to the traditional approach to IG bonds and government bonds, how much are retail investors missing out on?
Yeah, no, it's a great point. I'll try and quantify that for you, Lee, to give a feel. So, starting right in the bottom left, so government bonds, highest quality bonds out there, typically issued by governments, so very unlikely to default. But in exchange for that, over the long term, we don't expect them to outperform cash or base rates, really. So not giving you that additional return. So you have to look at other areas to do that. You can do that within agency MBS, which is mortgages that are backed by the US government, but again, very low risk. And because of that, they only give around 0.5% above US treasuries or US corporate bonds over the long term. So again, not meaningfully contributing to returns. Investment grade corporate bonds, you might get a little bit more. So like a lot of things at the moment, corporate bonds are expensive. So you're only getting less than 1% in excess of government bonds. So again, not really making a meaningful difference. And that's what we've seen over the long term as well, that they don't tend to generate much more than 1% above cash or above government bonds. But if we start looking into the green alternative areas in there, asset-backed securities, which I'll come on to, but depending on the quality, we see an extra uplift there again. So generating around 2% per year in excess of cash, but some more like 3% as well, if they can take on a little bit more risk. Similar with emerging market debt as well, tends to be around 2 to 3% above cash. And then we move into high yield bonds and bank loans, which are a little bit more speculative. You're taking on a bit more credit risk there. And you get a higher interest rate or a high yield to compensate for that. So over the longer term, we see those generating 3 to 5% above cash. So getting upwards towards high double digits in the current environment. And then private credit, which isn't accessible at the moment for retail investors. But again, similar types of risk, but more illiquid. So again, tends to generate slightly higher return of say cash plus 6 to 7 over the long term.
That's great. Cheers, mate.
No problem. So moving on, as I mentioned, we wanted to do a little bit of a deep dive into a particular area that we think is a real differentiator that a lot of the retail space is missing out on, and that's asset-backed securities, or ABS. So firstly, what is ABS? So it's a bond asset, similar to corporate bonds in a way. But unlike corporate bonds, which essentially involves lending directly to a given corporate, and that bond will repay interest plus the principal at maturity as long as that company remains solvent. Instead, what ABS is, clues in the title, is it's a bond that's backed by a pool of assets. So a classic example is mortgages. So a mortgage-backed security will be backed by a pool of thousands of mortgages. So as those mortgages that everyday people like you and I have, as they repay, then that bond will also repay. But if for whatever reason some of those mortgages don't get repaid, then there's a property sitting behind each of those mortgages that can be sold to recover the investment. So it just makes it a little bit more secure, and that's different to what we see in the corporate bond space, which doesn't tend to have that asset sitting behind it. Now, there's a lot of information on this page, but distilling to the main point of why we like ABS is that it can offer higher yields and therefore higher returns than corporate bonds of a similar credit quality. So we're not necessarily taking on extra risk, but over the long term, it's generated around an extra % a year. So that sounds too good to be true. So what's the catch? What's driving that? Well, a lot of the time when people hear ABS or asset-backed securities, they immediately think back to 2008 and the global financial crisis, and they make the link of, is this subprime stuff which went bust in 2008 and caused the recession? But these structures are very different. So that was a lot of US subprime mortgage risk. There's none of that in the market today, or at least in the areas where we invest. So we're looking much more at prime UK, European and US consumers that are a lot stronger, hold a lot more equity in their properties and provide a lot more protection. Secondly, we're investing only in the senior tranches. So They're the first to receive any income that comes through from the mortgage pool, but they're also the last to incur any losses. So to quantify this, during the peak of the crisis in 2008, we were seeing default rates on those underlying mortgage pools at around 10% in a lot of examples. And that's relatively high, as you can imagine, but even that wasn't enough to create losses in the senior mortgage-backed security bonds. They're designed to impair quite prudent and quite bad environments, and they've certainly strengthened in that regard as well. So to make that clear, we'd need an event worse than the global financial crisis, sustained over the life of the bond, for it to incur any losses. So it's a lot more secure than people realise, but the fact that it has that stigma means that it tends to generate a higher return overall.
Tom, I've had a question come in. So if the assumption that this is a liquid market and an inefficient market, if you like, why are you getting an improved yield or return for a similar rating compared to a corporate bond?
Yeah, it's a great question. It's a challenge we get quite often. The main thing on top of what I mentioned is there's a lot of regulation at play here. So take insurers, for instance. They're a big institutional investor that invest a lot in a variety of different bonds. And before the financial crisis, they were investors in ABS, and they'd love to invest in it now for the reasons that I've mentioned. But because of the regulatory framework, it's very difficult for them to do that. It's very expensive for them to do that because they have to hold a lot of capital alongside it. And that's a lot of regulatory overhang from 2008, where there's been a lot of prudent regulation come in. So insurers, big amount of capital can't or doesn't tend to touch this area. Whereas if you're a different type of investor, a retail investor, let's say, you're not under those regulatory constraints. You've got a competitive advantage. You can allocate to this area if you understand the risks and how it works, and take advantage of an area that another big investor can't touch. Now, there's a lot of people campaigning for that to change in the insurance world, as you can imagine, and maybe it will do it in the future, but for the time being, that's creating a big opportunity. And as I mentioned, on top of that, I think that's the main reason, but on top of that, there is still a bit of a stigma around anything that's branded asset-backed securities, bit of an overhang from the financial crisis, and again, that can create opportunity.
Yeah, absolutely. It's the uncertainty, it's a nervousness of, previous events and history, but it's over time. Time will outpass and outlive. You can see that through the timeline of events, can't you? Really?
Yeah, exactly. And I won't bore you with too many statistics and how the market's evolved, but the market we see today, very different to 2008, and the data supports that. Defaults have been incredibly low. In fact, investment grade ABS, there's not been a default since the crisis. So thankfully, we're coming up to 20 years since the crisis. So hopefully a long enough time period to assess that over.
Yeah.
Anyway, I will pass over to Ben, because you'll be glad to hear it's not just bonds where we think an institutional approach is beneficial. There's certainly learnings for the equity side of things as well.
Yeah, thank you very much for that, Tom. So I think turning the page now to equities. So I think we've just covered the bond and the credit market and what impact that has at a portfolio level. But now let's focus on equities. And this, in part, may be a more familiar area, which you'll be sort of aware of in terms of the equity component of your portfolios, which typically has been, one of the sort of key return drivers. So I think it's really important to really disentangle that and understand it, and understand the differences between the traditional retail approach and what we see on the institutional side. So I think really sort of kicking off on this page, we've got a few points which we'll walk through, but feel free to jump in if you've got any particular questions. The first thing we want to start with is, in the sort of traditional retail approach, we do observe that there is a large cap focus. Now, as we'll come on to talk about, and Ajith alluded to in the start of this presentation, when we look at the equity universe, what we do on the institutional side is we effectively mimic the total investable universe. So that's not just limited to, large cap companies. That also includes mid cap and smaller cap companies. So that is a key difference in terms of when we look at portfolios. Generally in the retail space is a lower allocation to, smaller companies in that space, and there's some real opportunities there which we'll come on to talk about. So that's one key difference. The second key difference is if you look at home bias. So if we look at traditional retail portfolios, they have been largely concentrated, in UK equities for some time, and that is in part, a structural overweight as a result of maybe comfort with, the home market, and that's not something that's employed on the institutional side. So that's very different. And maybe just to put it in context, in terms of if you look at the total investable universe and actually think about, what does the UK account for as a percentage of the total investable universe? It's only a very small proportion. So if we look on a market cap basis, the UK only accounts at 4%, relative to the total world size. So there's many other markets which are so much bigger than the UK. And when we think about institutional investors, they're really taking that market-wide approach and allocating to other markets and not having structural overweights to, any particular market. So that is a key difference there. Maybe going on to the second point we'd like to pull out in terms of a key difference is over-reliance on active management. And again, it goes back to the sort of the key point around our philosophy in terms of, how do we invest on the institutional side? In the traditional retail approach, you generally see active management across the whole portfolio, and there's no consideration for where it's actually used. We've got a slide in this deck, which we'll come on to talk about, which really looks at the efficacy of active management, because I think something that we're very mindful of with active management is that there's fees associated with active management, and they can be quite high. So, if you want to, pay for active management fees, you've got to deploy it in the areas where there's the best chance of outperforming. So on the institutional side, there's a much more considered use of active management. So, some of the areas that we like in terms of, where do you deploy active management is, for example, we'll come on to this in terms of the detail, but, emerging markets and small cap have a much better efficacy in terms of delivering outperformance relative to the more larger cap global developed names. So that's a key difference there, and that can often obviously have quite an impact on fees at a portfolio level. The third one is the illusion of diversification. So, what do we see on the traditional retail side? We often see many line items, but often these line items can be doing very similar things. So when we look for diversification, we look at exposure, and that exposure means, where are you allocated on a regional basis, on a sort of cap weighted basis, on a sector basis. There's many different risk drivers which we look at when constructing portfolios. So we, on the institutional side, do not believe that diversification is achieved just by having, a number of line items and differing manager approaches. That's not diversification for us. Finally, we often see quite high manager turnover, and this in part is a function of having many line items in the portfolio, but you can often see active managers moving in terms of being terminated, fairly quickly. And that might be because they underperform over a, short-term time horizon. And there could be good reasons for that. It might be that that manager's style is out of favor, at a given point. So on the institutional side, what do we do? So, it's a much more holistic approach in terms of, assessing a manager's role in the portfolio. So, we look at team, we look at business, we look at process, we look at their philosophy, we look at risk management. There's so many factors that goes into assessing whether, should an active manager retain its role or have a role in our portfolio. So those are the things, and that is a key differential. So those are the things that I'd say probably differ between the retail approach and the institutional side, and it's important to get all these right. So that's the sort of the first few key points which I'll go through. Maybe if we sort of go on to the next slide and we can look at portfolio construction. So what is the starting point here in terms of portfolio construction? So there's one thing I probably just want to say up front, which is really important. When we look at constructing an equity portfolio, we want to maximize return, but within a certain level of risk. So every time we look at equities and what they've delivered over time, it's what have they delivered for a given unit of risk. And that's exactly what we're doing here in terms of this analysis. So I've talked about the institutional approach, and we sort of typically invest on a global basis, and it's really our starting point, and the first point we show within this the chart on the right hand side, which shows ultimately a 100% developed equity world mandate. What has that delivered over the last 25 years and for what level of risk? And you see an efficiency ratio ultimately. So how do we take that and improve it? So if we look at the sort of the line further down, what we've done here is we've chosen a strategic overweight to key markets, which we believe are very important and form part of the total investable universe. Now, that is emerging markets and small cap. And by including those markets into these portfolios, you can improve the risk-adjusted return, and you get the impact of essentially mimicking the total investable universe. So that's something that we'd pull out there. And there's not just a sort of a quant process for this in terms of, we just look at the numbers. There's also good qualitative considerations of why you'd include emerging and small cap in portfolios as well. So that just gives you a bit of an indication for, what do portfolios look like and how do we build them on a sort of total basis. Ajith referred at the start, there's some innovation that we do within these portfolios, especially in the developed space. So even though we are sort of passive and in the sort of developed space, and I'll come on to talk about this on the next slide, there is some innovation. There's some really interesting things that we look at on the developed side. So
Ben, what are some of the qualitative reasons for adding small cap?
I think, well, first of all, it's a great question because small cap really for us is underrepresented in terms of what we see in investors' portfolios. I think the first thing for us, and it goes back to a key philosophical point, is diversification. So you get much more diversification by including smaller companies. You get an exposure to the real economy. Some of these small companies which are driving the day to day that we see. They can often be, if you look at smaller companies, there's some real gems that you can uncover. And typically on the smaller company side, we prefer active management. So you'll be able to see, there'll be some companies which really thrive and grow into be mid caps and large cap companies. So being able to identify those companies and include them in your portfolio can have quite a meaningful impact on return. It's also a less researched area. So if you look at the large cap companies, so think about the Mag 7, they're very heavily researched. There's lots of broker notes. They're very well covered. But in the small cap space, it's less well covered. So you can really identify, some of those gems in that space. And there's also other factors as well. But I mean, those are some of the key factors that we consider, for example, small companies.
Thanks, mate.
Yeah, no worries. I'll move on to the next slide in terms of time, because I want to sort of be able to get through the presentation. Just a few words on this in terms of implementation. We've touched upon this, and I think a really interesting statistic that I wanted to share with you. So some of you may have seen this from various different sources, but if we look at global large cap managers in terms of actually, we know they've had a difficult time, but what have the numbers been in terms of how many managers have actually, outperformed? And you can see from the chart that we've got on this page that only 4% of global large cap managers outperform, which is really quite stark, and there's reasons for that. But it's quite meaningful. It's very difficult to pick a global large cap manager which will outperform. And what you are guaranteed to pay with global large cap manager is the fees associated with that. So that's why there's been, a lot of sort of underperformance in that space. So that's something that's been seen, and that, what we show here is over the last 10 years. However, the bit that I just wanted to touch upon very quickly is within emerging markets and smaller companies, you've seen much better efficacy in these markets for active management outperformance. It's still quite challenging, so you need to make sure that you do deep due diligence on these managers. But when you get the manager right, you can really see some meaningful outperformance, which is what we spend our time on in terms of active manager sort of selection.
Why is that, Ben? What are the drivers behind that? Why are in some markets active managers having being outperforming?
Yeah, I mean, I think it's I suppose a great question. So if you look at, for example, emerging markets and smaller companies, and why is it easier for managers to outperform in this space? It probably comes back to the point I was sort of just saying earlier around lower analyst coverage. So there's less sort of analysts covering the stocks within that space. So there's more scope to identify securities which are mispriced relative to, if you look at the large cap space, pricing can be quite efficient in that space. Clearly things move around from time to time. They don't always get it right in terms of the market, but that is a key facet. You also see within emerging markets and small cap quite high return dispersion. So if you look at the sort of potential range of outcomes, let's say it's wider for emerging markets and small cap. So you can really identify maybe some of the names which, are sort of not good to hold, particularly within smaller companies. If you think about smaller companies, not all companies actually, sort of profit making. There's companies which, rely on financing. Things can get quite tricky. So I think those are the things to think about in terms of, if we think about portfolios and where to deploy active management. There's some definitely key areas which, we'd focus on.
Good.
Okay.
Right. So
thank you.
So let's move on to the next slide. So far, Tom took us through the credit portion, Ben took us through the equities, and we saw how we were applying diversification within those asset classes. We talked about geography, we talked about market cap, we talked about consumer and corporate risk. So if you're constructing a portfolio, how can you add more diversification? What more can you do? And that's where we bring in what we call as a true diversifier. So what's a true diversifier? A true diversifier is one which has a very low correlation to the rest of the portfolio of equities and bonds. And one such example, a great example, is what we call as cat bonds or catastrophe bonds. So what are they? These are bonds issued typically by insurers or reinsurers so that they can share some of the risks in their book that is linked to natural catastrophe. I can explain it in more detail. So think of a corporate bond. You are, by buying a corporate bond, essentially you are making a loan to a company. In return, you're expecting to get some sort of interest payment, coupon payment, and your principal back at maturity. And the risk is if the company goes under, your principal is at risk. So that's the corporate bond. Now, coming to cat bonds, it's somewhat similar. You make a payment, and in return, you're expecting a coupon or interest payment, and you're expecting the principal back at maturity. But the difference, the risk is it's linked to a natural catastrophe. So it's linked to, let's say, it could be a hurricane in Florida, or it could be an earthquake in California. So why do institutional investors like this asset class? A, it gives you good risk-adjusted returns. So it's comparable to high yield, let's say cash plus 3 to 5% over the long term. So from a return point of view, it's not a bad asset. But that's not the reason why most investors include this. It's because of the diversification. It does really well in times of economic stress. And that's what you see in the chart on the right. So if you look at that first bar, that's a return of cat bond index during the global financial crisis. So if you look at the dark blue one, that is the equity performance during the same period. So peak to trough, equities did something like minus 55%. And during the same period, cat bonds did plus 6%. And that's massive. So I have first-hand experience with this. I used to work for a life insurance company in US. We had a 90 billion credit portfolio. And the only asset class that stayed above water during the financial crisis was cat bonds. And we needed cash at the time. So although we liked the asset, we had to sell the asset to generate cash. That's a different story. So that it has worked really well from a diversification point of view. Now, there are considerations like liquidity and so on and so forth that you need to think about before you include them. But we like this as an asset class, and that's a good diversifier. Now, so far we talked about asset classes that are currently in the portfolio. Now let's talk about something that's a future focus, and that's private markets. This is the hot topic for retail investors. And it's not new for institutional investors. So if you think about our book of 350 billion, almost 20 to 30% is in private markets. And that's invested across private credit, private equity, real estate, infrastructure. And there are a couple of fundamental reasons as to why institutional investors like this asset class. The first one is it's a growing asset class. So if you look on the chart on the right, it's expected to hit something like 30 trillion by 2030. So you can't ignore it. If you think there are a lot of companies that are going private. So in US back in 1990s, it used to have almost 8,500 publicly listed companies. By 2024, that had shrunk to 4,000. So more than half have left the public universe and moved to private. So if you don't invest in private markets, you're missing out on a big opportunity set. Two, you get good risk-adjusted returns. So compared to the public markets, you get something like 2 to 5% higher returns. And you're getting those returns because these are illiquid assets. You can't trade them you can't get in and out of them very quickly. So for holding on to that asset for longer, you're getting what is known as the illiquidity premium. So there's a higher return, but it comes with a catch. In summary, it's more of a question of when, not if. We strongly believe that there'll be a lot of innovation, like you've seen in the DC market, that'll come into the retail market, and retail investors should be able to invest in these assets. So hopefully that's clear in terms of the big differences, the asset classes that you use within institutional space. In the interest of time, I want to quickly cover the final section, which is when we bring this all together, what does it look like in terms of portfolios? So what you see on this page is a portfolio comparison under these two approaches. On the left, we have picked a typical retail portfolio from a competitor. We have anonymized it. So that's the traditional retail approach. On the right is under the proposed institutional approach is our portfolio, which has been running for the last 1 year. So they are both moderate risk, one retail approach, one institutional approach. And at the bottom, these are the layers that we talked about, we have been talking about in the last 45 minutes. And not surprisingly, you can see that the retail approach has all the issues that we talked about: high allocation to equity, using bonds as a risk management tool, high allocation to active management, and a lot of rebalancing. And on the right-hand side, not surprisingly, our portfolio, we have fixed most or almost all of those issues. So then the question is, that's great. From a theoretical point of view, all of this makes sense. What does it mean in terms of performance? What about the outcomes? And that's what we want to show in the next page. So this is what we're showing here is the dark green bar is our portfolio, our moderate risk portfolio over the last 12 months. And the light green bar is a peer group of 370 portfolios that we have taken from Morningstar. So all these portfolios, including ours, are in that 40 to 60% equity bucket, so moderate risk. It's great to see that since inception, last 1 year, we have outperformed that peer group of 370 by 6%. But that's not what I'm interested in that. I'm more interested in what's on the right-hand side, which is there's a lot of focus on downside protection. March, as we know, was a tricky period because of all the geopolitical issues. And you see that institutional approach, focusing on not just equities, using bonds, not using duration, using selective active passive, all of those things have played into our portfolio delivering better downside protection. So you can see that there's a 1.5% difference between our approach, institutional approach, and the 370 portfolios as a peer group from Morningstar. And that to me is super critical when you think about the institutional approach. It's not just about the returns and high returns and all of that. It's also how it protects you on the downside. I'm conscious we have to, hopefully that gives you a clear idea of institutional versus retail, how you think about portfolio construction and what it means for your investors. Let me take a quick pause to see if there are any final questions.
No, we've been behaving. We've been answering the questions as we go along. So as always, I know we're coming close to the hour mark. So if anybody does have any final questions, then please do fire away. Loved the presentation, guys. Loved it completely. New to the market in terms of MPS, but not new to the industry. I think what you guys are creating and what you guys are building, it is different, and it's opening the eyes up to the retail. To the retail sector, if you like, that there's other options available, right? There's other avenues, and diversification, innovation, and it's all good stuff.
Thank you. Thank you. And
yeah, go.
And thank you from our side. Thank you very much for the opportunity. We really enjoyed doing this. Any follow-ups, please reach us through Lee, and we'll be happy to answer the questions.
Absolutely. So as you exit today's webinar, there'll also be a part that says, would you like to hear from ISIO? If you'd like to explore this a little bit further and what impact it can have on your clients and your business, do let us know, and we can pass on that introduction as well. We are bang on the hour mark, guys. Well done. Thank you, everybody, for joining us today. Please do come along and attend our other webinars if they are of interest to you. It's been a pleasure as always. I hope everybody has a wonderful bank holiday weekend, and we will see you all very, very soon. Gents, thank you very much.
Thank you.
Thanks, Lee.
Thanks, guys.
Everyone.